This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 140, brought to you in association with Smart Pension. And I'm delighted to be joined today by Freddy, CEO of Credit Kudos, to talk about credit scoring. Credit Kudos are interesting in that a few cognoscenti, whose views I trust, have recommended them to me as being cool, or is that hot, or both. I always replied politely to my buddies, as there must be a billion fintechs who've promised to do credit better using big data and lots of other jazz. However, just as I've heard folks say that they will do investing better for many decades, a related branch of credit scoring if you think about it, and I'm still waiting for consistent outperformance by any fund managers. Equally, the first time I heard folks say that they do credit better was about 30 years ago in North American banking in Climewards. They got bonuses based on how many deals they did. What could possibly go wrong? Yes, and indeed they did credit much better until a couple of years down the track they took a complete bath when the credit cycle tipped. Anyway, I bumped into Freddy and chums at Lendit recently, and he didn't seem to be fazed by my utter scepticism about credit. Maybe he's heard the scepticism before. Furthermore, measuring credit performance is a function of the length of loans. Do 50-year loans, and you'll have to live several lifetimes for anyone to judge whether your performance is any good. Do shorter-term loans, as Freddy says they do, and you'll have a real measurable track record. Plus, as lots of cool dudes tell me that they are hot or cool or hot or something, let's find out for ourselves. Plenty to talk about, so let's get on with the show. Hi Freddy, thanks for joining me today.
Thanks for having me.
So, you were saying that, like everyone else, you're very boring because you're an entrepreneur, but then when I twisted your arm, you did mention minor matters like having played rugby with England internationals and having cooked for the President of America or something, but maybe I'm getting things mixed up here.
No, that's 100% correct. Both of those have somehow overlapped into fintech as time's gone on, but I spent the first couple of years of my life working in San Francisco, which makes you very fat, it turns out.
I thought you were going to say it makes you very gay, actually, but...
Well, I mean, that too, possibly.
It's very fit as well, fat and fit, because there's lots of hills.
Fat.
No, but what about those hills? Do you not walk up them?
No, there's all kinds of ride-sharing apps that are subsidised by venture capital that allow you to not pay to get anywhere. But I got into cooking and went to culinary school, and that somehow aided me in building a business because I was able to bake cakes for conference organisers and get into the events for free. So it all kind of worked out.
And what did you cook in cookery school other than cakes?
All sorts. I don't know, anything really. Lots of unhealthy, expensive stuff is the short answer. I think anyone who goes to San Francisco realises it's just kind of this playland for people that earn too much money and work in tech companies and want to spend it on something, and food invariably is one of the vices.
Yes, indeed. It does seem to be getting a bit of a Hunger Games society. I think actually it wasn't San Francisco, it was Los Angeles, where I saw Paul Joseph Watson a little while ago did LA as a shithole, typical sort of polemic. But actually he did seem to follow it up with quite a lot of video footage of people sleeping rough and sort of feces on the streets and plague, and the social conditions have really deteriorated. And also the commutes got far worse than back in the day when it was California dreaming and there weren't many cars in LA and you had 15-lane roads. It was all quite nice, and now it takes 1 million hours to get there and back. But San Francisco, I remember, because when I was young, so if you're going to San Francisco, be sure to wear a flower in your hair.
I do. I know the song. Yeah.
Oh, right. I thought you said you did. You did.
No, I didn't. As we mentioned, it's perfectly acceptable to do so, I think. I agree. I noticed the same kind of sort of division between wealthy tech bros, for want of a better term, and they've got a huge sort of homeless population there, and then not a lot in between, right? I think one of the things that ultimately led me to leaving that part of the world was it was just quite one-dimensional. You know, you go into a bar and pretty much everyone you meet will be working for Google and doing exactly the same thing, and will have probably been in the same office for most of the afternoon before arriving there, and it kind of lacks a little sort of diversity in that respect.
Yes, well, I'm sure you benefited on the other hand. I mean, we're probably not far away from both Tom and not that far from Go Cardless. Hey, Rocky. I think they certainly got quite a lot out of working for whatever that incubator is over there, the really famous one.
Y Combinator. Yeah.
Americans do or do not. There is no try in America. Whereas over here, there's quite a lot of piddling around. Well, we'll give it a bit of a go and hope it works kind of stuff.
No, definitely. And the acceptance of failure as well is much better there. I went through Y Combinator with the first company I went to work for when I moved there. And you know, in England, you start a business and it doesn't work and people go, oh, you failed, you know, that was terrible. Whereas they go, oh, you didn't get it quite right, let's try again kind of thing. And I think that's partially, you know, the reason that they've been so successful in building so many valuable companies.
Yes, absolutely. And it's something we could learn very well. So we'll have to gloss over how you made cakes for the England rugby team for another day, or lead to lots of listeners emailing you. So your career journey was, you decided to go to San Francisco one day with or without flowers in your hair, and you became a sort of San Francisco techie type person, at which point decided to come back to London and do credit, or was there something in the middle?
That's broadly correct, minus the flour.
The flour was in the baking. See what I was doing there? You missed
that
one.
Okay, sorry, the leavening agents. No, so I studied computer science in England, in Manchester. I decided that...
You claim they invented the computer, of course.
Well, yeah, they did. Yeah,
I don't think they did, but that's another story.
I'll debate that all day. I studied and then decided that it would be more interesting to work in somewhere that was slightly less rainy and slightly more sunny. And so San Francisco was a good fit.
As was most of the rest of the world, other than Ireland, I guess.
True. I went through a program called Silicon Valley Internship, which was a very grandiose name for let's put a bunch of tech people on a plane and send them to startups and give them jobs and hope that they'll do cool things. And that was how I ended up being landed in a startup in that part of the world.
That must have been quite fun at a young age.
It was incredibly fun. Yeah, I mean, we all had no idea what we were doing, but the ability to kind of command quite a nice salary for doing tech work in that part of the world at that age was quite unique, I think. And I've always said that, you know, we're very lucky, people that studied computing, because we've got this kind of, at the moment at least, it's probably going to diminish, but we've got this advantage that we can write code, and that's useful to almost everyone, and you can get quite far just being able to do that. So I had quite an enjoyable couple of years working for various different tech startups in the Bay Area.
Yes, it's interesting how this programming, as it used to be called, and now writing code or coding these days, has actually become more relevant, and it's only really become relevant because of the interweb, insofar as I did computer science a little while ago at somewhere that did invent the computer, and you know, you kind of could get jobs doing that, but it wasn't very cool kind of stuff. You know, it was better than doing natural sciences, but it wasn't that good for chatting up chicks. What do you do? Oh, I do computer sciences, and it sort of ruined many a wonderful relationship kind of stuff. And I did actually think about doing Anglo-Saxon, Norse and Celtic, because I thought that would be sort of cooler, but that would have been hard work. But as you say, in the interweb age, I think that's the thing that's really changed, rather than the invention of the computer per se. I mean, if you're doing COBOL or Fortran programming in the 60s, you wouldn't have got many hot chicks either. It's made the difference, and as I mentioned on the show before, trying to persuade younger girls, I'm still trying to persuade young girls, this time my daughter, that actually getting a job in this kind of thing is really good. It eventually worked. I take the view that very simply that we've had these eras, you know, we were hunter-gatherers for, 50,000 years or something. And then one day someone says, oh, let's become farmers, and they became farmers.
Yep.
And at that stage, and we're literally in whatever, the metaphorical equivalent to the first 10 or 20 years of becoming farmers, if you got into farming, your family was sorted for the next, 5,000 years? And then literally a couple of hundred years ago, someone said, oh, let's build steam engines and factories and this kind of stuff. And if you got into engineering and factories, you were kind of sorted for 200 years. And then suddenly goes, oh, there's all this information, let's play with this information. So I can't see any people in this industry kind of being unqualified for anything in 10, 50 years' time. I imagine in 500 years' time it'll still be done. I mean, there'll probably be something else as well, but...
No, indeed. And it's also, it's just any business, it's not just finance that relies on some form of repeated process or pattern recognition or something where you do the same thing over and over again. It's ripe for doing that with a computer, right? And we're suddenly at this point where, because of the internet and because the cost of all this stuff is so much lower, you know, we talk about fintech, but really, like, there's any number of places that this stuff is relevant. And I think this kind of group that I consider myself as one of guys and girls that did computer science and have this skill set that at the moment no one else has got, or at least not everyone has got. We're in this unique advantage where we're high demand right now, but I don't imagine that'll always be the case.
Yes, and I don't know if I mentioned the example before, maybe not, but it is pervasive. So I'm a big fan of MotoGP. Marquez just won the championship recently. And it was astonishing. I think they were saying the other day, I've forgotten, I mean, it's something mad, like every second the bike collects 50,000 pieces of data or something like that.
Yeah.
So, you've got the last of the gladiators sitting on the thing, and riding it and crashing over 200 miles an hour and all that kind of stuff. But actually, one of the huge things that makes the difference, of course, is the bloke on some computer in the back who's got 5 gigabytes of data, and from 5 gigabytes of data, or whatever, per race, they distill basically just an algorithm that decides how much petrol to put in the engine.
Yeah.
Wow. And that's just riding a motorbike, so it does affect everything. Good. Okay, so having discussed all the interesting things in the world, we're now going to go into sort of credit scoring, which you'll try and sort of tell me is a fascinating use of technology. And as I said before, you're dealing with somebody who's heard far too many things already, so you can convince me that sort of credit scoring works or something like that. But first of all, let's just start with basics. So when you say credit scoring, what do you mean by credit scoring?
So, credit means trust, effectively. So a credit score is designed to be a measure of trust, or as some people describe it, sort of like a financial CV. And when someone wants to lend money to you, or increasingly just provide you any kind of financial product at all, or in fact not just financial, but any sort of high trust product, they use a credit score or some form of credit data to figure out whether they can trust you. And that's kind of like the broad definition.
And in terms of the market then, what you're talking about there, I go and buy a sofa or something on, I don't know what it's called now, it used to be called hire purchase.
Yep.
And the shop makes a phone call or something, or puts my data into something, and I come back with sort of 1 out of 100 as a score, and they say, sorry, sir. And you go from all that up to rating sovereigns and saying, I don't think Russia will go bust, and that kind of stuff. So it's obviously a very wide market, and then multiplied, I'd say, by maturity. There's lending people money for a day or two, where fairly soon you get a good track record, and there's lending people money for 50 years where you haven't got a clue whether it worked until you've seen the cycle.
Potentially, yeah. So for us, it's about the trust of consumers and providing money generally to those people and trying to be most efficient in those decisions.
Just in terms of sort of narrowing it down, what kind of client base do you have or do you serve?
So for us, anything in consumer credit, so loans, credit cards, mortgages, motor finance, so the hire purchase type products, and the sort of anything in between those types of products. It means when an individual is applying for something and they need to be ranked effectively in terms of how likely they are to default or a prediction of that, we provide an ability to do that.
And what kind of timescales?
Anything from a few months to a few years. With mortgages, obviously, it can be much longer, although in those contexts, we're less, and I'll talk about what we do specifically later, but we're less concerned with the prediction of that, because that's more hinged on the asset and the market than it is necessarily just the person, but about finding out whether you can trust that person and then giving them a process that allows them to evidence that really quickly. That's kind of where we play.
Okay, so historically then, how did these assessments work? I mean, I don't know the likes of Experian, I don't know how long they've been around, probably a long time, quite a few decades or something. I was a merchant bank, so we didn't lend money to people such other maybe private clients, but then it was against their portfolio. And certainly on big corporates, there was a file in a cupboard and people look at the balance sheet and stuff like that.
Yeah.
How did it work? And then after that, we can move on to how that has been changing. I don't know, for the sake of argument, since Zopa started in 2005, where obviously they're doing a lot of the markets you're talking about there, and it occurred to them as well to try and enrich the data and all this kind of stuff. Yeah,
so the way that it works in the UK, we've inherited the US system, so we have 3, in fact, all US-owned now credit bureaus, so Experian, Equifax, and TransUnion. They all use something broadly similar to the FICO model, which is the Fair Isaacs Corporation, which was invented in the 50s in the US. Basically, that's a model that combines your repayment histories, the amount you owe, the amount of sort of the length of time you've had credit, the types of credit, and the number of times you're applying as a kind of single score. And that in the US is effectively linked to your social security number, so you have a unique identifier. One of the problems we have in the UK is we've kind of imported that, but we don't have ID or social
We've
security
got
numbers.
national insurance numbers, which is a similar thing, isn't it?
Yeah, but we don't use them publicly as an identifier. So what happens here is we use your name.
Why not, just in passing?
It's a good question. I don't know. I think that they fall out of the realm of data that you can use from a data protection perspective that can be shared. I think.
How strange.
Yeah, it's always been this debate. Obviously, we had the ID card debate thing 10 or so years ago now. But what happens now is that you have your name, address, and date of birth being the reference point for your credit file, which means that every time you move house or you...
Yeah, it's a pain in the arse. Yeah, no, I'd be really curious about this one actually, because just thinking about it, I need to do my tax form, and on my tax form it's got my national insurance number.
Yeah.
And that's kind of, well, it's not how they know who I am, but that's the bit that they use to identify me as a unique individual, and your number would be different.
Yeah.
So I hear what you say about the ID cards, but going back to open banking and open everything and open blah 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 and data and mumble, I'm sure I'm missing something, but it wouldn't really cross my mind to worry very much if I told you what my national insurance number was. It might cross my mind to worry about telling you what all my bank account numbers are, but people give those away. So
yeah, no, it's a very good point, and there's so many businesses that grapple for this single identifier, because you do have this situation where Joe and Joseph blogs are two different people and end up with markedly different results, and trying to just get the right information for the right individual can be a huge challenge. And also then when you look at the whole sort of KYC and identity problem that so many good companies are trying to solve at the moment, it kind of stems from the same root cause.
And I suspect that GCHQ has got my fingerprints and all that kind of stuff. I mean, it's probably not supposed to, but some countries you go abroad, it says put your hand here or something, and don't tell me they don't share
States
that.
Especially,
yeah, exactly. Okay, so the state actually has unique identifiers for all of us, and it may have other biometric information, but that's a separate conversation. Anyway, so you know my name and address and all that kind of stuff, and so you presumably didn't set up Credit Kudos just to do the FICO algorithm as well?
No, indeed not.
And do we know how accurate that is?
It depends how you measure accuracy and over what type of product. It's quite a blunt instrument. It's kind of the base that most lenders use, and also there's an interesting distinction, because although we think ourselves as having a score, like a number like you described, out of a 999 or whatever, most lenders will not use a score when they make a decision unless they're quite new to the market. They'll take all the different bits of data in their raw format and then try and do something slightly more differentiated in terms of how they decide. And a big part of getting an edge on the market is that secret sauce, if you like, so that that there's no sort of single universal decision-making process, because otherwise why would you have all these different lenders? The way we do things that is different is we use data that's consented first and foremost. So we use open banking data as our primary input.
Consented, that must be an Americanism, surely. It wasn't in the dictionary when I was young.
Well, with consent.
No, I wonder whether there was a term in the market. This is consented data.
Yeah. It's.
Well, you did computer science, not English. We can't expect to hear more.
I'll just take the flak for that. No, what I mean by consented, or choose your appropriate term, is that a traditional credit bureau works by storing this information over time through collection through rules of reciprocity, which basically just means that banks and utilities companies and other actors in the market will share data periodically over time with each other to build up this view of you. But you as a consumer don't go, oh, here's my information, make a decision. We use open banking, which, as you know, is this way of sharing data securely from a bank with the consumer's consent, hence consented, so that we can see your actual financial history over a longer period of time, and then we can use machine learning, I said it, to predict using that information whether you're going to repay. And the way we do that is by tying up the before and after. So we know, this is what your bank account, or this is what Joe Blogg's bank account looked like when he applied for this credit card, and then this is the data that shows that he repaid it. Use that as a input into a model and try and predict for new customer B whether they're going to repay.
Right, so I get that. And in terms of abstracting from all these complicated terms like open banking and data and machine learning and all that kind of stuff, basically you look at people's bank accounts and you use a computer, and the computer try a computer program which is different from everyone else's computer program, and your computer program is better, going back to the sort of cynicism about performance of fund managers. But in terms of when you started Credit Kudos, what was the motivation? Because, say, Zopa founded in whatever it was, 2005, funding circle and rates set about 2012
Yep.
or something like that. And teasing apart, they all say the same thing. Oh, we use data and we use the computer and we have our own program and our own programs are really good. All right, okay. And to the extent that when I last heard about all this sort of stuff on a little bit of inside track, saying the Wizard of Oz would be very rude because it wasn't quite the Wizard of Oz. But shall we say that some of the algorithms weren't massively sophisticated?
Yeah. No, very fair.
So what was it that made you think one morning, and was it just sort of you drunk too much the night before or something? Thought, hey, none of those guys know what they're doing. I can do it far better.
Yeah, good question.
What was the opportunity that you saw?
As with anything, it's the quality of the data, not the magic computer that processes the data. And all of this new data was going to become available as of this year. And so that was the real opportunity, is it's making a system that takes advantage of that data and turns it into this ability to predict credit risk.
And you guys formed?
In 2015.
Oh, right. I thought you formed a while ago.
Yeah.
So when you formed in 2015, your motivation wouldn't have been that open banking was going to come along, or was it?
Yeah.
Oh, it was. So you had to wait a long time then?
Yeah, well, so we originally accessed this data through screen scraping, which was like a way to get hold of that data without proper APIs. Now we use APIs, but same fundamental model. We also, when we started, we recognised that it would take quite a long time to convince the FCA that there was a need for a fourth credit bureau, and we needed to start that journey and go through that process. So that was a big part of the early work.
So are you now a credit bureau then?
We are, yes.
Oh, I see. So you're like the Experience and that only a little bit smaller?
Yeah, quite a bit smaller comparatively. But there's not many. There's only a handful of companies that provide that service, and we're one of them.
I see. Okay, so you use all this information and you use computers like everybody else, but in particular you've been sort of chomping at the bit for some time to access this type of information. And when you go and, as a credit bureau, flog your services to, I don't know, banks or something, or peer-to-peers or something like that,
Yep.
do you do what I used to do in the past and go along and say, I've got really good performance, give me your money and I'll manage it and I'll do really well? Is it literally you sort of, you've got a track record and you've got an API, oh, I've got an API as well, and I'm looking at that track record, it's wonderful. I mean, how does the market work?
Yeah.
But I mean, if I'm somebody who's trying to choose some 4 credit bureaus and I've got loads of money and I'm going to pay you millions of dollars and all that kind of stuff, everybody turns up and does a beauty parade. I assume that notwithstanding the fact the world is all quotes completely different, everybody turns up with a PowerPoint and it says we're this and that and look at our track record here, and a bit like venture capitalists, they all claim that they outperform.
Yeah, essentially, I mean, certainly the 3 existing bureaus, they all provide fundamentally the same service, and their differentiation often comes down to the types of customers that they already serve, and therefore what part of the sort of pool of data they can provide visibility into. So Call Credit, which is the kind of youngest of those 3, which was bought by TransUnion last year, entered the market with a really good ability to refresh data faster, for example. So the differentiation was quite small historically. What we're doing is using this totally different set of data, so it's quite a new unknown quantity, I think, for a lot of companies, and what we're able to do is exactly as you say, is come in and say, we've got a track record in using open banking data to predict risk, and here's some examples of how this works. And we're helped by the fact that because this is this new data source that everyone, we were at Lend It last week or the week before, and pretty much everyone was talking about open data and open banking, and it is a buzzword, but it also is a huge opportunity because you've now got this much bigger picture from which to draw the information about the consumer and make a decision.
Yes, I mean, all these things like open banking and that does rather remind one, talking of young girls and that, of the sort of teenage attitude towards sex. I mean, everybody talks about it, but not that many people are doing it. I mean, everybody talks about open banking. I get a million emails a microsecond about open banking this and big data.
Yeah.
But actually, I'm actually relatively surprised, given that I thought I'd heard about lots of people doing sort of something like you guys, that as so often, there's a lot of sort of heat and not much light.
Yeah, I mean, I think especially early on, I mean, the harsh reality is that the open banking was effectively launched in January of last year, but wasn't actually ready until the middle of the year, and most of the early publicity was kind of tabloid newspapers telling everyone how much this idea wasn't going to work, and that if you go to people on the street and ask them if they want their banking data to be open, they say no, which is hardly surprising. But what we've found in sort of the last 6 to 12 months is that actually, in terms of making better lending decisions, people are quite willing to share this data, and banks and lenders are quite willing to use it and quite keen to do so. I mean, the interesting thing has been that early on, a lot of these banks, the big 9 banks in the UK, kind of felt like they were being dragged through this process. You've got to give us these APIs. This is a compliance thing. You've got to make these APIs available.
You're losing the USP that you've had for centuries, which is you're the only one that knows about Mike Balliman.
Yeah.
Now everyone else is going to know about him.
So yeah, exactly. I mean, there's kind of loyalty by inertia stuff that people talk about. But now that they know that this data is out in the wild, the impetus is on them to do something clever with it too, because they can no longer just sit on it, right?
Yes. So part of this is, of course, like many things in life, the economics of the media and of digital media. And we all have seen clickbait. We've all seen how clickbait has in many places turned into hate bait. But we've also got hype bait. Something that comes along like open banking, and there's a million articles about, oh wow, that's going to change the world, all this kind of stuff is going to be amazing. And they know this beforehand, then it'll be, oh, it didn't change the world, it's complete rubbish and no one's going to do it or whatever. It's this sort of hype cycle stuff, isn't it, really? Which is exacerbated by the fact that they're all desperately trying to get eyeballs in a world flooded with data. Whereas behind the scenes, what you say strikes me as the realpolitik of how many things have happened over the last 15 years in fintech, which is that in the short term, less changes than everybody says, but in the long term, more does. And things build on things, but it takes time,
Yeah, no, I mean, it's definitely true. And when you talk about something as fundamental as credit risk, expecting that to change overnight, especially in a large bank, is very naive. And I think also with stuff like open banking, there's been this expectation that it's going to be this cool thing that everyone's walking around wearing open banking t-shirts, and probably the reality is that if it's successful, no one's ever heard of open banking, and it's just a means to an end, in the same way that direct debits and faster payments and all this other stuff that no one's really heard of.
And nobody cares about it. It's like plumbing and electricity and all that kind of stuff, or the loos, the sewage.
Yeah.
No, exactly. So I would, for example, apply for a car or a sofa online or something, and tick this box so they can check your bank data, or tick the box, and I don't care, but you come back and say, yes, I can have it.
Yeah.
And from the vendor, or whatever it's called, perspective, then the only thing that they really care about is, do you incrementally, quotes, outperform? I don't know how you actually measure. How do you measure performance then? So I say, how well do you do it? And you say, oh, we do it 5% better than those people that you just saw before. I mean, what? So in fund management, obviously, people come along and say, oh, our returns are FTSE plus 10%, or LIBOR plus 15% in our bond market, or something like that. So it's relative to an index.
Yeah, I mean, I guess it depends on who you're talking to, but there are standard measures, things like AUC, like area under a curve, or Gini score, G coefficients that statistics buffs will use to measure the relative performance of two models. The challenge with that is it's very rare that you have a situation where you can do an apples for apples comparison between two different things.
That's what I meant by what's the benchmark. Well, so, for example, let's take motor finance, which is pretty well defined.
Yeah.
So let's take motor insurance. I mean, the motor insurers know what the claims have been this year and the premiums and all that kind of stuff. And then next year comes along and, last year there was an 11% claims ratio and the average claim was for X. So there's lots of stats. And the motor insurers, let's say there's 10 people insuring motor insurance. Then this year in 2019, Liverpool, Victoria may have completely outperformed and had 1% claims rather than 11.
Yeah.
So they did 10% better, and someone may have had 21% claims. So that's how the insurance market works. In the credit market, then I assume, for example, that in motor finance, for the sake of argument, 4% of people defaulted this year. Yeah.
Yep.
And then I will assume that somebody like yourself will say, oh, well, actually, in our case, only 1% of our clients defaulted. That's what I'm kind of talking about. And rather than Gini coefficients and clever maths and all that kind of stuff, it really is simple. If you have a benchmark, isn't it?
Yeah. I mean, the way we look at it is kind of between sort of precision and recall, which in simple terms are like how many people are you getting the right decision for, and then how many people of all the people you apply are you actually able to come up with a decision. And one of the reasons that's really important is because we're able to score people that traditionally are unscorable. So people that get rejected, very often, this is part of a wider trend of sort of changing consumer behaviours, but people who work, non-salaried jobs, so they're sort of gig economy, or that they're new to the country, or they've got thin credit files where they've not built up this kind of FICO score. Open banking gives us a way to shine a light on those people and include them in a lending decision where you otherwise wouldn't be able to. But the rates of default are generally fixed by the lender, and they say, this is what my tolerance is, and then they build everything up from that position. So they figure out their appetite for risk based on that, and the score, whatever scoring system they're using is designed to most accurately map to that appetite for risk. And so where we come in is to make sure that whatever we're doing, whether it's increasing the acceptances for a lender or reducing the time in the process or name your application, that we're sticking to those bounds.
Right, okay, so it's not like being a fund manager where you give them some money and a year later you've got 11% more, but the FTSE went up 21% or it went up 1%. As you explained, there are more parameters because you're a vendor, as it were. You're selling a service to people who need to fit it into all this stuff. And the point that I hadn't sufficiently appreciated was that it isn't just a question that in the past the models will say, Mike gets 42 out of 100 or something like that. In some cases, the models go, I don't know, we can't calculate this person's score, which is not something. I'd assume that everybody had a score, but I can quite understand that, let's say the FICO works off 99 variables, that you're going to get 9 on me. It doesn't actually produce something. So extending the range of people you're covering is clearly a good thing too. So where do you see this going in the future, Freddy?
So more data is generally better to any kind of decision-making problem. Payment Services Directive 2, that is the kind of very badly and unsexily named open banking legislation, means that you can get hold of this data in any European geography as required by law. So we now have an opportunity to make this type of credit scoring approach work across borders, across different countries, which would solve a massive problem for a lot of people whereby you can't take your credit information with you can't take your credit score with you. And I think that's the kind of general movement that our product and others is capturing, is this idea that, I own my information. It's not a credit bureau's job to tell me what to do with it. I should be able to exchange it for best value. And whether that's, a car insurance company using a black box in my car to measure how good a driver I am, or Fitbit telling me that, I'm not going to the gym enough so that my health insurance goes up, this value exchange should exist in lending as well. And I think that's the direction of travel.
Interesting. So globalising the data, and we won't get sidetracked on what happens if by some miracle we ever leave Brexit the day after, whether you will get un-PS2'd. Anyway, before we wrap up the show, I'd like to thank all the listeners out there. I'd like to thank my brand partners for the podcast, Smart Pension, who are fast, secure and free. Check out their UK workplace pensions at autoenrolment.co.uk. So we've mentioned Credit Kudos once or twice. I think we got away with it. What would you like to tell the many, many, many listeners?
So we know that this new data is much more powerful in making decisions. We've proven it, and there's more coming, as I alluded to, in light of PSD2. We're helping people make faster, more accurate credit decisions, and that's genuinely driving a huge impact in terms of their ability to lend to customers they weren't lending to before, or to better understand the ones that they already know about. And I would say that if you don't have a strategy for open banking or new open data writ large as a lending company, then you need to get onto that and get in touch.
And like many things, the world changes technologically and all that kind of stuff, but you don't need to keep up with everything. You just need to have someone who will do it for you.
Exactly, and that's our role.
And in terms of, if any of them are listening, you say lending institutions, but specifically what kind of clients are the best clients who should be leaping out of the crowd with their hands in the air for you right now?
So we work with a range, as I mentioned before, but the ones that are serving customers that either require a lot of manual due diligence, so for example mortgage or tenant vettings, we can help those people instantaneously understand the risk of those types of customers, right through to unsecured lending. So we do a ton of work with credit card companies, loans providers, motor finance, as you alluded to before, particularly because they've been given a bit more of a regulatory push in terms of how they assess affordability, credit brokers and everything sort of above. But generally, if you're lending money and you're doing it online and you can benefit from knowing more about your customer through open banking, then that's where we can help.
Excellent. Well, I think the thing that I hadn't appreciated, and which is probably why so many different people suggested you guys, is that obviously, you must be quite good if people are recommending you in a busy world. But B, contrary to my expectation, it doesn't sound like everybody's doing this. Everybody might be talking about it, but there aren't many. If there's you and 3 mega ones, then you're the little mammal trying to eat the dinosaur's eggs.
Exactly, yeah.
Good. Right. Well, I wish you successful meals in the future, and I hope open banking gets opener. And well, I wouldn't worry about Brexit because that's never going to happen. So we'll keep PSD2ing for years, exactly. And Boris will be sort of chained to Parliament, with Parliament going to the court every other week to get him in to wash their cars or something like that. So anyway, I wish you every success in the future, Freddy.
Thank you very much.
Thanks for listening. If you have consulting, advisory/non-exec or media needs in the FS or fintech space, get in touch with me at mike@londonfintechpodcast.com.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moon ride, watching a happy moon ride. To come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.